Welcome to Property Perspectives. I'm your host, J.G. Kemp. We got wonderful guests. They've been here before. This is a good friend of mine, Neil.
Thank you,
And
Jay.
Madhu. You want to introduce yourselves?
Neil Caron. I am the area manager for CMG Mortgage for Connecticut.
Yep.
We oversee the entire state. I think we have about 10 offices now and 30 loan officers, and happy to be here.
Yeah, thanks for coming.
Yeah, Madhu Renduchintala. Work with Neil in South Windsor.
How you say that last name again?
Renduchintala. If you sound it out phonetically, it's exactly how it's spelled out.
Okay.
But been with Neil for about a little over 20 years at this point.
Yep.
21 years.
Yeah.
Just
A lot of experience.
yeah.
A lot of experience. Definitely go-tos. And CMG Mortgage, there are more places than I thought they were. I've been driving different towns, seeing. I seen them the other day in Glastonbury.
Yep.
Yep.
Yeah. We did a deal for a guy in Georgia.
Yeah.
Yeah.
We did.
Yep, and then we tried to get you in Massachusetts.
Yep.
So that's a good thing to know if you're trying to refer business or you send family somewhere else.
Yeah.
Got the
The
hometown
acquisition
guys.
of Norcom was huge for us.
Yes. Okay, so Norcom is the
Yeah, CMG, I think we've been in the state now for a little over a year, and we are now we just passed a milestone. We're the third largest lender of CHFA in the state, and that happened in a pretty short amount of time, so we're proud of that.
Third.
Number 3.
Yeah. I know who number one is. That's a big deal.
Yes.
It's a big deal. So how's business?
So far, I thought we were going to go through this winter period where there was going to be a slowdown, where there's going to be slim pickings. I got to tell you, I did not see a slowdown at all this year.
Not even like around July, August, September last year.
So, I mean, even that was short-lived, I mean, you'd probably go like a couple weeks here and there without, a lot of activity, and then just all of a sudden, floodgates would open, That's just been a repeating pattern that I've seen, talking to everyone. Obviously, not everyone's as busy as they'd like to be. You could always be busier. I know you and I are kind of like that. But
very much so.
I haven't seen that slowdown.
I think it's important to look at it two different ways also, is that I think from a real estate perspective, if you look at transactions, I think you felt a little bit slower on the real estate side heading to the end of last year.
It did.
What we've seen on the mortgage side isn't necessary. Well, we've seen two things. One is competition on the LO side is limited now. So 2021, there were 500,000 loan officers, give or take, maybe 5.
In Connecticut?
In the United States.
Oh,
nationally.
and that's the low number compared to agents.
Yeah, so I got to measure this one nationally. But 550,000 loan officers. That was the peak 2021. I think somewhere right now, fast forward 4 years, we're at 79,000.
Really?
Yeah.
Nationwide.
Nationwide. Ooh. So when you have that happen,
Yeah.
you feel it a little bit stronger on the loan side.
Yeah.
We're busy because our competition's limited. And one thing that's changed for us that's very interesting is we went from having a handful of realtors that we did all of our transactions with to now we are onesie twosie. We've got, when we look at our spread, we probably have 3 or 4 realtors that we've done 2 or more transactions with, 3 or more transactions. And then we've got an entire host of our roster that's one.
I believe
and
it.
done. Yeah.
I believe it. I've been noticing with my prospecting. 2 years ago, I call, and the number I'm about to say is still a low number because you go to major markets like New York, Miami, Vegas, wherever, the numbers for prospecting is probably more ridiculous. But I remember calling and I'm on the phones when I'm supposed to be, 8 in the morning, giving away secrets to the sauce here. And they'll be like, "Oh, you're the 6th, 7th person calling at 8 in the morning."
Oh, yeah.
I'm calling now. It could be 9 in the morning, and I'm the first person to call.
Oh, yeah. Yep.
Well, I think that goes along with, there's, a lot of your competition has, the people that are left in this business right now, are the ones that weren't in it for the quick buck. They were in it. This is the career.
This is the career.
This is the
100%.
career. They live off, you and I live off referral business, stuff like that. This is what we do.
Yeah, this is what we do.
It's easier to get into it when, 2020, 2021, when, you can just take an app from your home and, you don't have to go out prospecting. It just falls into your lap.
Now you got to work.
Yeah.
Now
Now
you gotta
it's
work.
about
You said
working.
something last
And,
time.
and again, if you're not working right now, then no, you're not busy.
No, you're not going to be busy. And it's funny because I mean, I don't know the mortgage. First off, I've just noticed you guys are a good barometer on how the market's going to go. It just clicked to me. If you're busy, that's telling me that we're going to be busy.
Absolutely.
If you tell me it's slow, I mean, because you need a buyer.
Right.
I can list all I want, but if I don't have no buyers.
We're seeing a timeline, right? So Madhu and I were looking at this the other day, and it was interesting. We got busy, but the clients buying houses right now are people that we talked to 18 months ago.
Right.
People that have been sitting on the sidelines for a very long time, looking at things and saying they're unaffordable. I'm going to wait for it to get better. I'm going to wait for my time. I'm going to wait till rates come down. And now
I think people realize this is
it, right?
This is it.
Our market is a 6.5% interest rate.
Yep.
The prices are where they are.
Yep.
Are we going to see a retraction? Maybe.
That's hard to say.
Hard to say.
We have low inventory still, but the inventory is slightly up this year. And but the days on the market are lower. Showings to a contract are lower. You know, so houses are still flying, but now it's more being priced aggressively. You have to be priced aggressively because buyers have a little bit more option. But I just seen a fact that we have one of the hottest markets in America, the Northeast.
I just wrote a
saw
piece
that
on
too,
that
yeah.
too. So Hartford County, #1
Yes,
in the United States.
I see it.
Yeah, it's true. So when you look at, you never think about that, and it's not just Connecticut. It's Hartford. It's our
100%.
city, so we are in the epicenter of the vacuum, I will call it, right? So we don't feel it as much as a market like Florida does right now. You look at Florida, days to market. I think Florida, I just read an article, healthy market is about 6 months of inventory is what I think I read. So if you have 6 months of inventory, that's considered a nice, healthy real estate
That's a
market.
nice, healthy market. I can see that.
Florida's at 12 months right now.
Oh, yeah, they're up.
Yeah, Florida has the exact opposite problem that
Total
we
buyer
have.
market. We're still in the seller's market. We're at 2.2
Yeah.
absorption rate, meaning we have 2.2 months of inventory.
Yeah, and I think some areas have less than 30 days. I think there's areas
Yeah.
that I read
Oh, yeah.
where, so for us, we hear about it, we read about it, we're not seeing it yet.
I'm not seeing it yet.
We're not seeing it yet.
Got it. So you mentioned the 6.5 to the 7%, which is interesting. They keep saying, they said it all last year, pretty much they were going to drop, and
They started dropping. You know, I mean, you got to remember, you know, at the beginning of the year, you saw rates like 7s and 8s. You know, you ended the year down in the 6s. Yeah.
It doesn't seem low right now, but we eclipsed 8%.
Yeah.
So, you know, we had people that were buying houses. Well, actually, we should say that's about the point it screeched to a halt.
Right.
About when it hit about 8%. But we had to remind people that when Madhu and I got in the business, 1999, 2000, rates were 8%. So my first loan I wrote was 8%, and the people I remember were jumping for joy at the dining room table because you had to go to their house to do the applications then. And they couldn't believe that the rates were so low.
that's traditional.
Yeah.
That's traditional. I just heard a guy the other day talking about a new program that they're thinking about, which is basically sellers financing, but it's people who got caught in with the 2s and the 3s and the 4s. They're selling their homes, and they want to be basically the bank. So they would give it to them at like a 4 or 5, take the percentage that they're getting back on the payment, and then go buy a home and have that compensate for their rate that they're getting now. Have you
Yeah,
heard
I
about
mean,
this
it-
program?
It's a variation of an assumable mortgage.
Yeah.
Right.
So
That's what I was going to go with, assumptions.
So a variant that we're seeing on that right now is what people are doing is, so veteran, VA loans, FHA loans.
Yeah.
VA loans and FHA loans are assumable loans. They're the only product out. I believe the only product.
Oh, they are?
Probably, yeah.
Yeah,
didn't know that.
so any VA and any FHA loan, yeah, you can't do it on I don't think Fannie and Freddie. Conventional does
I
not
don't
allow
think-
for
yeah,
that.
I don't think so.
So government loans, they allow assumability. So essentially what happens is, round numbers, you got somebody that owns a house, it's $250,000 owed on the loan. I can come along and I can say, I really like your house. And you can say, well, I owe $250,000 on it. Would you like to take my mortgage over? And if you qualify, you can take my $250 as it sits with the current rate that I have. So if somebody bought 4 or 5 years ago at 2.5% or 3%, you get that 3% loan.
Right.
They work out with you the difference of the spread that they want.
Right.
That's what you're talking about.
And that's on us. And that's
Yeah,
totally permissible.
because like you're not just gonna like let's say like that $250,000 house like when they at that time where rates were 3%,
Yep.
you know that's probably like what the value was. Now that value is probably 400,
They're-
and so you're not just
Right,
gonna
right,
walk
right.
away from like 150,000. You're gonna you're gonna have to figure
100%.
out where that 100.
I don't remember exactly what it stands for, but it has to probably do something with assumable mortgage. There's a website called ROAM, ROAM, and Rome has an entire inventory nationally of homes that they show you the spread. They tell you this house is available,
see that?
and you can
That's
buy
advanced.
it. Yeah.
That's advanced.
Yep.
How's it looking with the home building loans? You do those?
Oh yeah.
You do those?
Yeah, we do a few different, we're big renovation lenders, big rehab lenders.
Mm-hmm.
We have some construction products, but we're primarily on the renovation side.
I got a good question for you. How do you think that the tariffs are going to affect the housing market, or even?
Don't get
I think
don't
it's-
get Madhu going with his conspiracy theories here, so.
I think the tariffs is going to make it significantly harder for builders to build houses,
Yeah,
to build
yeah.
affordable housing.
That's what I'm hearing.
I think it's going to be a problem. Like we're in a market where we have, one, not a lot of undeveloped land, and two, shortage of inventory. Right. So I have a very pessimistic view of the viability of tariffs, specifically when it comes to the housing market.
I think we'll feel it here the most in New England for that reason that Madhu just said. So if you go out to Arizona, Florida, Texas, they've overbuilt, right? If you start reading right now, you can see they built these tract homes very inexpensively all through the pandemic. They're having trouble selling them now. Now they're competing against properties in older inventory.
Right.
We don't really have that problem here because we don't build 100 tract homes. So we're going to feel it here because you're going to have builders that, a big development for us is like 6 homes going in South Windsor, right? But now, if the cost of goods goes up and they can't, the cost of housing, it could be, builder confidence is down, first time ever. This month, builder sentiment and confidence is lower. However, a lot of it is rhetoric right now.
That's a fact.
I mean,
Sure.
I know you and I go back and forth with this a lot. None of it's really happened yet, but should it happen? Yes, it could be a problem.
So I remember last year when we had you on here. For everybody that don't know, maybe you want to go back on property perspectives and take a look. That was a good couple conversations we had. Very educational. I believe in now more than ever. The content is very important. Whether they're watching or not, we're building the content so they have something to go back to if they choose to. You said survive to 25?
Survive till 25.
So here we are.
Yeah, so here we are.
So what are you thinking?
I think it's thrive in 25.
Yeah, I think we're past the surviving stage.
I mean, I think if we're sitting here, we survived.
100%.
Back to Madhu's point early on, and we look at our competitors, and I don't like to dictate to people or pretend that I have the ultimate game plan. But it's very easy to see right now the people that are doing things and are active and are just have their head down and are grinding. Madhu and I, we grinded. I mean, this was we were on Easy Street for a while. I mean, like a lot of loan officers.
Telling me,
yeah, I mean,
It was nice just to be able to sit in your house and just keep getting phone calls. Yeah, put your app in. Yeah,
I mean, we're not gonna lie. We miss Easy Street. I mean, it was fun. But now, I mean, we're in the office at 7:00. Madhu's in the office much earlier than I am, and we're busy till the end of the day, and we're trying things, and some work and some don't. But I'm looking at my peers, and I'm looking at people that I emulated over the years, people that I look to, and a lot of them are down. I mean, some of them are up, but a lot of them are down in business. And as I talk to them, it's really kind of like, I'm kind of burned out, or I don't want to try those things, or that doesn't work. There's really no magic sauce right now. I mean, right now, if you're returning the phone calls, and if you're making the phone calls, and if you're interacting with the clients, and you're doing the education, you have business.
Provide good service, provide education, provide options. That's really what you can do, and when you know how to do that, your phone rings.
Which is good because a lot of people they're just doing a job. Like they don't know how to really talk the numbers. And as I get deeper into my career, I realize, that's very important to be able to understand market stats and be able to dictate that to the client, to educate them better moving forward. And so you could tell you guys are definitely working.
Providing education to people, so they can make informed decisions. That's probably the best way you can make your own job a lot easier, because if you can convey information and have people make, these informed decisions, it does tend to make your job a little bit easier, especially later on in the process,
Yeah, for you too.
Yeah,
We
100%.
push it on the staff. I mean, a lot of our sales meetings, a lot of things that we do are really encouraging everybody to be the mentor, to be the guide.
Right.
People can see right through that.
Oh, yeah.
And I get more often than not right now. We just had a deal yesterday that came together. A young lady called. We talked to her for a few minutes. In my estimate, 5 minutes I talked to her, which really isn't enough time in our world. But even after 5 minutes, she said, "Hey, we're just going to go with you." And I said, "Oh, really?" And she goes, "Yeah, you've spent more time than the last 3 people we called who just said, go to this website, do this."
Right.
She goes, "We appreciate that." So there is a human interaction. And when we talk about AI and technology and all this, I think it's a great supporting tool, but it'll never take away
Never.
the human experience.
Yeah, with AI, AI is only as good as the information that's put into it, right? And when it comes to people filling out a loan application, sometimes like things are misread, sometimes it's just not filled out correctly.
Right.
So you still need that person to be able to go through it, know what the guidelines are, and be able to go reach out to that person and
That's a
say,
great
like,
point.
hey, I know you put down this, but there's things that are missing or things that aren't complete, whereas if that was just up to AI, they get to a stopping point and it just stops and that's
It's a great point. It's a great point. And a good banker, a good mortgager is like a roadmap, I always tell people, right? They're able to tell you what you need to do if you're not right in the situation now to buy. You can break down the scenarios, kind of like you always hear people say, that's a tax write-off. That's a tax write-off. But tax write-off isn't always that great,
Right.
especially when you're trying to show income, right? You made 100,000 and you wrote off and you only made 40, 50. So you thought you qualified, but you actually don't.
Right. I'm dealing with a gentleman right now who, has like a day job, someplace, has a self-employed business where he shows a $30,000 loss, and I have to sit there and tell him, well, that 30, I've got to, that now takes away from your other job, dollar for dollar. Like that's a loss we have to count against you.
That's a loss.
So it's.
One of the other things I've seen, though, also, and that I would encourage anybody that's watching this or anybody that we interact with, Madhu and I have also been very surprised over the last few months where we've had people call us and our immediate reaction is to say, I don't know if this is really going to go anywhere, or at first glance here, I don't think we have anything. And then we get deeper into the application, and we've had more and more experiences like that, where people call us up very apprehensive, and it's our immediate judgment of reading what they're telling us and saying, well, they're so they're so tepid right now that they probably don't qualify, and let's get a little deeper in it. And we've been pleasantly surprised. These are the majority of our clients that all of a sudden realize that with $60,000 or $80,000 or with a time to own loan, you can get into a house. You can buy it.
Yeah, actually, it's funny that you say that. Not even just time to own. There's other programs like the Housing Development Fund, where because they offer such robust down payment assistance programs, I've been able to turn an FHA buyer into a conventional buyer and open up what it is that they can go look at. Like I had one where a seller would not accept FHA financing. I combined the time to own program with the Housing Development Smart Move program, and that now qualified for a conventional loan.
Okay, so a lot of people who don't understand that, what is the difference between the FHA and the conventional? And how would you separate the two to get one from FHA to conventional?
So FHA is going to be a little bit more lenient when it comes to credit standards. If you have like a below a 620 score or 640 or there's some credit challenges. FHA is probably going to be the most forgiving option for you. Conventional is looking for not perfect credit, but they're looking for solid credit, solid established history.
And one of the major differences, conventional spells out to you, okay, if your interest rate is this, your credit score, if your credit score is this, your interest rate is this. If your credit score is this, your interest rate is this. If you put down this amount of money, your interest. So there's a lot of factors that go into what they call loan level pricing adjustments, and it's not cookie. It's cookie cutter in that you either fit the box or you don't, and your score in certain facets are going to dictate your interest rate in the end.
So FHA is a little bit more lenient, like you said.
Correct.
Almost one size fits all. I mean, I hate to see that, but FHA says our rate is 7%, and it's 7% for
Your mortgage insurance
everybody.
is this, based on your down payment, and that's it.
One family, 2 family, 3 family, 4 family, 600 credit score, 800 FHA's rate 7%.
Yeah.
Which brings up there's a couple points in this. Something changed with the 3-family buying, right? Can you no longer do like a time to own or
You
100%? Fine.
You can, but the issue with 3s and 4s right now, it actually has a lot to do with the cost of housing. So with 3s and 4s with FHA, you have what's called a self-sufficiency requirement. So, like, let's say you take a 3-unit property, right, and it's $1,000 a month for rent. 75% of the rental income from all of the units in that property have to equal the mortgage payment. That's self-sufficiency. If it doesn't, you cannot qualify
You don't
FHA.
qualify.
Okay. All right.
Yeah.
Okay.
So 2s does not have that restriction. 3s and 4s do.
Gotcha.
Madhu, I heard you mention the HDF fund, and I'd like to make a shameless plug. I heard CMG is the only non-bank lender that participates in that program.
Neil, you are correct. We are the only non-bank lender that
What is the
participates.
HDF?
So
Jason, I'm glad you asked that question.
So HDF stands for the Housing Development Fund. They offer a bunch of different down payment assistance programs that you can combine with CHFA. So when CHFA went away with being able to combine down payment assistance and time to own, this program really filled in that void for some people. There's a program called Smart Move where it gives you 25% to put down. You pay that back at a 3% rate over 20 years. So not only are you paying less in interest, you're paying a lesser interest rate.
It was 10, no?
Huh?
Was it 10 before or was it always 20?
So Smart Move is always 20. It was always 20.
You have to live in it for 10.
Correct.
Got
yeah. So yeah, the Smart Move program, they give you 25% to put down. So not only are you paying, less in interest, you are also amortizing quicker because it's due in 20 years.
Have you ever done any HDF loans?
No.
Okay,
That's the first time I'm hearing
all right,
that.
so you will definitely something we should follow up on. Definitely something we should spend some more time on. We could do a little segment we could spend because time to own has always made us a little nervous, right? So CHFA, as you know, time to own program is a limited amount of funds. It's not limitless.
Right.
We've been blessed in that every time it defunds, they refund it. We are getting down on funds right now, 10 million, 8 million, somewhere around there.
Yeah.
We think it'll get refunded, but when it wasn't going to get refunded initially, we had to go look elsewhere. The HDF is really probably the closest thing you're going to get to a time to own. And I think we just had one at $80,000, right? Didn't we do it?
Yeah.
So it gives your borrowers, if you've never used it, it's something that if they qualify for, we got to look at it.
So is this based on map area also? Towns?
Somewhat. More so for like median income and stuff
Income
like that.
limits,
That's great.
usually.
That's great.
But we've done more. We've been very successful in pairing up CHFA, HDF, time to own too,
Yeah,
right? Yeah,
yeah.
we've got a few of them.
In one.
All three.
Yeah, so like I think the largest bundle I've done was 5 loans on one property.
So that not turn kind of takes less from the funds of a time to own, right?
It could, yeah.
Yeah, it could,
Yeah.
and to a borrower, right, who instead of financing $300,000 all at one
What's called
rate,
it's like six and a half today.
they can get $80,000 of it at 3%.
Over 20 years, yeah.
They can get $25,000 of it for free, and when you really start incorporating all of that,
Yeah.
it's a huge savings to a buyer, especially
Yeah.
a first-time home buyer.
Yeah.
So lending changes. You see any coming?
I don't know.
The only thing that I can really foresee, I mean, because like
Well, yes, they're always coming.
yeah, so like as the industry gets more data, right, they'll revise some things. But in terms of like qualifications, you're not going to see like sweeping changes that you saw after the financial crisis of 2008, 2009, right? Most of the loans that are done nowadays are built on stable financials. They're based on proving your income.
I can tell you what we're feeling. I mean, I haven't seen it, but we feel it in the air. Higher scrutiny right now on appraisals. We're definitely seeing that.
I was going to say that's going to be your biggest.
I mean, I think that's what you're going to see first. We've seen companies exiting the HELOC space, right, or tightening up the home equity space because that's a signal that property values may be pulling back a little. I don't think we see things drop off a cliff, and one of those reasons we didn't touch on was if foreclosures, and we'll talk about that in a minute, but if foreclosures enter the market, which we haven't seen a lot in a long time, we haven't seen any in years.
Right.
We have such pent up demand for buyers that I don't think we feel it like people think. So if people get into financial trouble, if there's distress, if houses go delinquent, we have hundreds of buyers right now ourselves that are looking to buy.
Wow.
So I think when you build that up, and I think when people look to the future and say, hey, if there's a retraction, if we get into it, I think you're going to have just as many buyers that are behind the scenes.
Yeah, I mean, look, we just talked about the building market. So I heard we were like 10 years away for things to start equaling out.
Right.
Basically,
it's entirely possible. Yeah.
And Connecticut has one of the largest housing prices in the country. So in addition to having one of the hottest markets, we also have one of the biggest problematic housing markets.
It's a huge affordability.
Just affordability and shortage.
Affordability and shortage.
Yeah.
Well, so I mean, I'm noticing, mortgages, they're holding steady. Like you said, there haven't been any foreclosures. For the investments, the rents have been holding steady. Mm-hmm. They have not been going up too much.
But that's kind of the problem with why, going back to our topic a couple of minutes ago, but that's kind of why there's that issue with financing multifamily properties with FHA. It's because the cost of the rents has not correspondingly increased with the cost of the property.
Yeah.
So when your mortgage payment is higher, but your rents are still, at a certain level, financing those properties is going to be extremely difficult.
What I'm noticing, and why we in Hartford probably have one of the hottest markets, is because we follow them. The New Yorkers, the New Jersey people, quote unquote, coming up 95. They've gotten to New Haven already. New Haven was one of the hottest markets last year. They ate that up, right? 3 families were going for almost 800,000. I've seen close to $1 million, right? We just comped out a 3-family in the North End at $500,000.
Wow.
In the North End.
Wow.
That was the first one.
That's insane.
You're right. And that's
going to market?
It appraised and closed.
Oh, sold.
Sold.
Wow.
$500,000.
Oh, so that's now a
And I'm
comp.
talking about in the middle of North End.
Right.
Right? We're not talking the outskirts or anything like that. So, I mean, when you're seeing that, that means they're here.
They
and
are.
The person who bought it was from New York.
I believe it. Yeah.
That's and to go completely off topic for a second, but to go back to one thing we talked about. So that's where technology can also be a hindrance that we've seen, right? Because they're building all of these AI models and all these automated valuation modules that look at appraised values, and we're trying to get away, in some instances, from a traditional appraisal.
Correct.
One of the big things that's been a push over the last 5 years has been to go to a more automated model where if the agencies agree, when you input all of your information, they look at the address and they say, okay, this looks like it could be worth what you're buying it for. They're trying to minimize the appraisal experience. Automated.
Yeah.
Somebody who does not go out.
Correct. Yeah. So
It happens today.
depending on like what your automated underwriting findings will tell you, sometimes it'll just say, you know what, don't bother with an appraisal. We accept the sales price.
We get that. So
Yeah.
you buy a house, put money down, and when the findings spit out of the computer and the magic sheet comes out, it'll say, no appraisal necessary.
I mean, we're going to come to anything in particular you feel like we need to talk about, tell the people about.
I mean, I can share a quick.
Yeah,
I can
please.
share a quick. So
Floor's open.
one of the things that's bothered me for the last couple years, actually for the last 5 years, is that going back to our foreclosures. Madhu and I were kind of looking at this a week ago. So we've been trying to figure out forever, where are the foreclosures? It's
Yeah.
not just Connecticut. When you look nationally, there are almost no foreclosures.
Mm-hmm.
You know, we looked at Connecticut, and Connecticut's a weird foreclosure state in that you have to go through 17 different hurdles to enact a foreclosure.
Yes.
So we just kind of chalked it up to that. Very interesting article in the Wall Street Journal a couple weeks ago, buried way in the lifestyle section of all places, like next to
I like
you know
that.
the best
You
golf
read it.
shorts to wear.
Wall
in
Street Journal.
Yeah, this season. But what was interesting was it was an article where it was talking about how specifically FHA loans, loan servicers today, the mortgage companies that collect the mortgage payments, are being incentivized to actually prevent foreclosures. And what happens is, back to the pandemic of forbearance, where if you didn't make mortgage payments, they put the balance on the end.
Right.
It's still happening.
Yeah,
And
I've seen it.
it's crazy. And it's a little, not little known, but little paid attention to, Mortgage Relief Act it's called. And it's still happening today. So last year, and I'm going to round these numbers around, there were 500,000 instances in 1 year alone where people went seriously delinquent. And mortgage servicers reduced their payments, added the principal to the back. And in some instances, there were $200,000 loans that had $50,000, $60,000, $70,000 added onto the back end. Is there an opportunity? I don't know. I don't know what that means. I don't know what that holds for the future.
That's very interesting.
But it's something that I want to keep an eye on, and I think not only does it open up maybe opportunity for houses to enter the market in the near future, it might also be the catalyst that kicks off a lot of regulation. So I would watch that. I don't know a lot about it. I was surprised to see it, but we're keeping an eye on it.
Right, that's interesting because again, looking for business on a daily basis. One of my niches is, foreclosures, and there's not a lot of foreclosures. You have to catch them in pre-foreclosure. How do you catch them in pre-foreclosure, right? But they have these banks that are working with them to try to stop them from developing
specifically
non-performing
FHA.
assets, right? Yeah. So that's very true. And I'm selling a house right now where the guy's in forbearance. He has to take a certain amount of money in order to close. Just to satisfy the bank. That's a good point.
And you got to think about it now. Why property values are elevated, we'll say that's fine. But what happens if we get a simple 5 or 10% correction?
Negative.
Well,
Now we're back in 07.
And then when you start introducing distressed sales, does that bring property values down? Because like we were talking about those comps where it goes up and up and up. Well, now if you have foreclosures, you have comps that bring that value down.
So not to end on doom and gloom, but it's just something that we're keeping an eye on. But I think ultimately it also opens up opportunity for the market.
Yeah. We can go on forever. I mean, as far as strategies and acquiring properties, we got the baby boomers on the way out. That's pretty much where it's at right now.
Yeah, whole nother the largest. I think it's the largest
wealth transfer.
And the largest demographic of home buyers, and they're starting later. The average age of that group on the millennial side is 33.
Yeah, I think so.
32 or 33. Buying.
Yes.
So we're just starting it and in the middle of it right now.
Yes. We're in the middle, exactly. We got like another 13 years or something like that, quote unquote. I just seen something interesting. We'll stop here because we could talk about it. I just got a client. They're like 76, 77 years old. Got 2 clients buying a first-time home.
We've got Carl right now. We just talked about this the other day. We were surprised, and not that
60-year-old, 70-year-old vet.
Age plays no factor in a qualification. But afterwards, I said, he's really excited. And I said, how old do you think he is? And he was like, he's a lot older than you think. And I said, first home? He goes, yeah. So we're getting a CHFA loan for somebody in his 60s.
Yeah. That's interesting. Yep.
We'll have to look into that. I wonder what that is.
I
have no answer.
I know, because this is like probably my third that I've seen. And it's very rare to see somebody buy or sell at that age.
I think rent. I think the cost of rent.
It is. 100%. Well, they were rent. That got to do with it too.
Now that's 100%.
These are a lot of barometers.
Yep.
That you folks need to look at moving forward, especially with generation, what do they call it? Gen Z.
Yeah,
Gen Z coming on. Well, it was good talking to you.
Yeah.
You as well, buddy.
You as well.
I really appreciate it.
Anytime.
We're going to do it again.
Yeah, absolutely.
My guy.
We like talking.
Love this.
Yeah. This is a good one. This is probably one of the best, man. This is Neil. This is Madhu. Once again, we want to introduce, let them know where they can find you at.
Yeah. So we're CMG Home Loans. We're in South Windsor, Connecticut. We have offices all over the state. Come by and see us.
Thank you very much.
All right. This is JG Property Perspectives. Thanks for having us. 5 Star Realty. Come see us again.